Welcome, everybody. We're just waiting for everyone to roll in. But excited to have y'all. Thank you for taking the time today.
Um, I think let's give it a couple minutes, and then we can jump right in. I will
Awesome.
change the slide to talk about what are we talking about, so everyone is clear on the topic for today. And I'm Evan Baldridge. I'm the COO of Better Bookkeeping. Our focus is really on small business owners, so that's what we brought in Mitchell to talk today, and wanted to really focus on this audience. So we're going to try to get your questions answered. We've gotten some pre uh, questions from the webinar link, and which is great. Thank you to everyone who submitted them. And then we've also been just getting them from our clients. So trying to keep this pretty streamlined in that regard. We do have a Q&A open on here, so if you want to ask questions, you're welcome to. We'll try to either get to them in the relevant section, or at the end, we'll make sure we have some time to go through any open questions. Mitch, you
Yeah,
want?
it's definitely the FAQ. So yeah, if you live in Iowa and the city of Des Moines and have typo negative blood and have the very specific, we'll do our best to either just answer the Q&A or we can find another time to talk. But yeah, today we're talking about the one big beautiful bill and what that means for our clients who are small business owners who have, you know, 200 to 2 million of revenue plus and are trying to balance their personal life and their business life and their bookkeeping and their taxes and get going. So I'm Mitchell Baldridge. I'm a CPA and a certified financial planner in Houston, Texas. I'm the managing partner of Better Bookkeeping, and we've developed a system to work with business owners so that they don't have to mess around with their books anymore or mess around with their tax planning or tax preparation anymore, and they can get back to work. So again, thank you for taking the time and jumping on today. And we're going to do our best to make this a experience full of golden nuggets for you.
Um, oh, favorite slide. If you've been to any of our other webinars, we enjoy the caution
Yeah,
caveat.
this is the my lawyer made me write this slide, and this is just I love it. It's explosive powered tool in use. Did you catch that? So, so ultimately, I am an accountant. I might even be your accountant, but this is for informational purposes. We're talking about general information. You are a specific one of one unique snowflake. So we want you to get the help you need for your specific situation. But definitely, this should give you a bunch of good information and help you, you know, uh, orient yourself towards where you need to go. But seek expert guidance for your situation.
Yeah, and for any clients of ours that are joining us today, we got you already. So we've already thought through a lot of these things, and we'll be continuing to address, as more unfolds on the bill. But we're going to just go ahead and dive right in. Um, as Mitchell always says, owning a small business is the best tax deal in America, and with this big beautiful bill, it's making it that even more so, or still so. Um,
Yeah, I think still says the key. Like, yeah, the idea around owning a small business is the best tax deal in America is like I used to have a W-2 job. I was an accountant. I drove to work. I worked at a place. I paid for my cell phone. I paid for my automobile. I had a little home office. All that was deducted. I would make money, I would pay tax, and then I would go, pay all my bills. As soon as I went out on my own and started kind of doing my own business, I got this whole new bucket of things called deductions, where I now I earn money and I pay my cell phone bill and I pay for my automobile and reimburse my home office expenses, and then I go pay Uncle Sam. So, and all of these cuts and all of these breaks and all of these things seem to be reserved for small business owners. Although in the one big beautiful bill, a bunch of employees and a bunch of folks out there got a lot of breaks, which we'll talk about. but you said, or we say, still the best tax deal in America. Like the big story around this tax bill, there was this big legislative change in 1986 around taxes, that really did a bunch for how we look at taxes today. And then nothing was really touched until 2017. They did the Tax Cuts Jobs Act, and ultimately a lot of the provisions in the Tax Cuts Jobs Act were set to phase out. Like this October was going to be this big tipping point for tax rates going up, tax issues starting to explode. And so, you know, the reason why this got through and the reason why it got through on July 4th and why it was such a push and such an initiative is just it was untenable for this not to happen. They pushed it through this process of budget reconciliation. We won't go full schoolhouse rock like how a bill becomes a law, but ultimately, they don't have 60 seats in the Senate. There's this thing called the filibuster. And so I think to preserve and save face, and so that every Democrat could vote against it, and most Republicans could vote for it, and the three people who wanted to be mad could get mad. Like they ran this whole process of running the entire tax bill through the House and through the Senate, through the US budget. And so we're adding $4.5 trillion of deficit over the next 10 years. And then all of these cuts had to score within that 4.5 so that we don't spend more. So that's a lot of the context of like why we did this the way we did this. But ultimately, nobody wanted nothing to happen, no matter what side of the aisle you're on, no matter who you are, because taxes were just going to go up for everybody, and that's a problem. So, yeah, that's a little bit of the background there. And so, yeah, we get to like the frequently asked questions. I've had, I feel like, hundreds of client conversations since then, and been thinking a lot about this and talking a lot about this. The ultimate, yeah, we're writing a bunch of, we have a bunch of questions, but not many people said, "Oh, QBI, that got extended, and that's why." And how does that matter for me? Like, really, the question is, what's changing for me? And the answer is it depends. So depending on kind of who you are and what age you are, how many kids you have, where you live, what kind of money you make today, like these are kind of the delineators of how this impacts you. So I wrote a thread earlier this week, and I tried to just break it into like income stratas, because that's one kind of clear way to think about it, and to walk through the phase outs and kind of what happens based on what. So ultimately, it depends. Your profit level determines everything.
We had a quick question about whether or not this is going to be recorded, and yes, we're going to record this for anyone who's attended. We will be sending you a copy of the recording, and for those who signed up and didn't come, we'll also be getting a recording. So the Oprah of recordings over here.
Yep. You can watch it and go to bed. It'll be great.
We can be
So
your put you to sleep. Hopefully not.
let's talk about the personal side. So starting out, like really that this was going to be one thing that was going to happen on this slide, like tax rates were going up. You know, we we were missing the one column of what was it before and what was it going to change to without OBBB and what is it now. But basically, the one big beautiful bill just extended out these kind of lower rates and made them permanent. So 37% is the new highest bracket. And these that starts at 750,000 for married couples, 626 for singles. It's going to keep being indexed for inflation. So ultimately, rates were going up, they're not going to go up. And that's as simple as that. Um the other big things that happened, and we'll talk more about these, but no tax on tips, no tax on Social Security, you know, the SALT provision going up. So this was a big deal of like how we're going to think about tax planning and tax prepping for most people. In 2017, the Tax Cuts Jobs Act, part of how they got money in the bill, or part of how they were able to do all these tax cuts, is they put a limit on the state and local tax deduction. So they said, all right, everyone's limited to deducting $10,000 of state and local tax. Well, the reason they did this is because coastal states are some of the higher tax states, New York, California, Oregon, what have you. And those happen to be mostly Democratic states. And so it was this whole targeted effort of like, why is the federal government backstopping your state growing their local taxes? Why do we care what you pay in local taxes? We're just going to cap it at $10,000, right or wrong. Or maybe I'm just making that up, but I don't think I am. So now, this $10,000 deduction's the cap, and they also raised the standard deduction to, close to $30,000 for married families. So, me and my wife can get $30,000 for free, or we can take 10,000, which I'm in Texas, so we have property taxes that are out the wazoo. We don't have state income taxes, but so our property taxes are capped at 10,000, and then we can take mortgage interest, and then we can take charity. A bunch of people who used to think about itemizing and gaming itemizations and really working around how they can stack deductions every other year, or different itemizing strategies, that just kind of went out the window. And they just said, I'm a standard deduction person. I have one tweet that makes everybody mad, of a guy who makes $6 million a year in a W-2, and he takes the standard deduction because he didn't give enough to charity. uh, for some people and how they feel about that. But he doesn't have a home mortgage. He has property taxes. They're capped at 10 grand. He doesn't want to mess with even saving his receipts and stuff. So he took the standard deduction. So a lot of people wound up in that spot. So now itemizing is a thing again. We have to think about, charitable contributions, state taxes, income taxes. It's worth noting that this phases out like people who, you know, make $500,000 or more of AGI, of adjusted gross income. It starts to phase out, and it goes back to $10,000 if you make $600,000. So the video is screwed up. So ultimately, that is worth considering. The other thing that, like, what people were doing to get around this out there today was, I'm back. What people were doing to get around this is this thing called PTET, the pass-through entity tax. Like, a lot of states started to develop their own program where within the state, you could go in your company and start electing to pay pass-through entity taxes at the company level. So my California S corp could go pay my California taxes, deduct them on my federal return, and then get a pass-through credit through the state. The good news, this was a hassle for us and a hassle for the client, because you have to elect on a certain date, you have to pay on a certain date, you have to kind of like get into this regime and worry about one other thing. And now it's really, really valuable if you do it right. You don't want to mess it up. But ultimately, you now don't have to really worry about this unless you make over $500,000. And it's worth noting that this is through 2029. So this is going to become this is one of these exploding provisions in the bill that's going to become a problem again.
Yeah, the thing that's interesting about PTET is a number of our clients, elect to go that method, to do that pass-through entity method. Your cash is outlaid at different times. Sometimes you're waiting for money from one entity, and you're paying the state, and you're waiting for money from federal. And so it just gets a little messy. And so the idea that now the cap is at 40 instead of 10, we were talking about this ROH, Mitchell's return on hassle, which is like,
Yeah.
Is the juice worth the squeeze once that cap moves to 40? And the answer for most folks that I'm thinking through is probably no, where it has absolutely been for, when it was capped at 10, of course. But now, and you have to pay, like, it's different per state too. So California and New York have totally different, and there's Oklahoma, and there's a bunch of different states that have this, and they're all different, and you have to pay at different times and whatnot. So um I'm thrilled about this one because I think from from a back office for just managing all those deadlines, making sure you're paying your $750 to the state at the right time to qualify. There's just a lot of different hoops you got to jump through when you do this PTET tax savings. So for anyone who works with us or wants to work with us, this is definitely an area we can talk to you about more depending on where you live. But this is an exciting one.
Love it. Um, and really, so again, now you have to worry about this if your gross income is above $500,000 and you own a company. Because important to note that pass-through entity tax is only available for business owners. Individuals who don't own businesses can't really use it. So here are the other big things. No tax on Social Security, no tax on tips, no tax on overtimes. These were all, these were all kind of fake. This is all marketing jive. Go figure that, like, the the marketing, the people who made the one big beautiful bill tell you no tax on Social Security. Well, no tax on Social Security is a deduction for people above 65 who make less than 75 or 150 if they're married or not, and 175, it just goes away. Same with car loan interest. You can get a $10,000 deduction on cars made in America if you make below 100 or 200, 150, to 150, 250, depending on if you're married or single. Some rules around that are like the car has to be final assembled in the USA. The loan has to be like a real loan. It can't be like, you can't just go take a line of credit. It has to be kind of like attached to the title. There were a bunch of kind of like odd things, but that's going to be interesting for all these car loan interest. All the car loan holders now are going to have to send everybody 1099s and manage all the compliance around this. That's another theme of this whole bill is like taxes are more complicated forever. Like it just, and in 2029 and 2028, when all these tax cuts for the middle class that were really, really supposed to be great all explode, they're going to have to come back and decide whether they want to reset all these. Or, I mean, someone in the House of Representatives could go put a line item bill out there that just says, hey, we're going to make these four deductions permanent. And if they did it outside of reconciliation and didn't have to deal with the Bird rule and the budget committee, like scoring it and making sure that it wasn't increasing the deficit too much, like someone could just go out and do this, but I don't think anyone will. Um, so overtime and tips, same story where, these are deductions. They're not no tax on overtime, and they're, the overtime's gonna, and tips are already a thing because there's a thing called a tip credit out there. So restaurants and employers who deal with folks who are earning tips, kind of payroll companies already know how to deal with tips. Frankly, payroll companies already know how to deal with overtime, but this is just another whole thing of your W-2 is now going to have tips on it, overtime on it, so that folks can get those deductions. One weird thing that's happening out there is that there are certain like marriage penalties now. If someone who works a lot of overtime is married to someone who works for tips, they can get kind of jammed up at the margins of these phase outs. But they're all weird scenarios, but now tax preparers are going to have to run scenarios for married people in these situations to decide whether filing separate will save the client enough money that it's worth filing separate. And so it's just more work, more complexity forever and ever. Child tax credit went up a little bit. They made the charitable deduction concept that, married folks who are not itemizing can deduct a little bit of charity. So that's really good for folks because everybody's got a little charity. You know what I mean? And most people weren't getting the benefit of that. Now you can. So now every tax return is going to have a charitable contribution line on it. That's something that everyone now needs to track and be mindful of.
Something I had heard, or somebody was asking or saying was that now all these people who have S corp owners who are paying themselves a salary, do they need to be considering overtime? Is that going to be some kind of advantageous option for them? They work 80 hours a week. Should they be thinking about that?
You know, that's tricky. The tip rule is very much like you know the the dentist client came to me and said, "Well, can I just replace a crown for free and put a tip line at the bottom of my thing?" And you can start to see that, like, if you're a dentist, no, it doesn't work out. You're going to make more than 150 or more than 300. And the tip rule, um, they did a very, very good job of, like, basically saying, look, you have to be in a tip industry. You have to be a server or a bartender. One of my friends owns a few bars in Houston, and he's really, really excited about this because his bartenders make $85,000 a year, and they're going to get a 25K deduction, and it's going to be awesome. But the overtime rules, I need to look a little bit further into that. Derek's on the call. Derek, you go dig into this of just like they've mostly put good safeguards around these for owners to not game these rules for themselves. But shoot, if an owner of a business making less than 150 or 300 all in can go pay themselves a little bit of overtime, and they're doing it the right way, and it's honest. Yeah. It's definitely useful for business owners, though, who have a lot of employees, to consider how can you restructure your employees in a way to is it worth it? Does it help them out enough? Is it worth going to your employees and saying, "Hey, we're gonna start paying you a little bit of overtime. You're gonna go get a deduction." Y you know, I think it's worth gaming out all these rules, and I need to do a better job of that real quick. We'll come back to that.
Yeah, it's just one of those ones where I think I'm going to start getting those emails of like, hey, can I pay myself overtime? Like, hey, should I pay my kid overtime? Yeah.
Should yeah, my
Yeah,
dog,
don't pay your
my
kid
service dog.
overtime. Yeah, can I service dog? Um, so anyway, we don't have to go and do that. We can move over to estate planning, which is also a big one where we put the little caution, go get someone to make sure that you have all your I's dotted and T's crossed with estate planning. But there are some things that are impacting with the new bill.
Yeah, so you know, ironically, you have all these clients that are I've had like 3 client calls since this thing has been passed, and going and meeting with them and their estate attorneys. The big thing was there was this estate cliff. The exemption was at about 15 million or 30 million, and it was going to fall down to like seven and a half. Like, and all these rich folks were hemming and hawing about what am I going to do right before the year ends to set up a trust and fund the trust and push all this business stuff around and do all this work. And it was this big thing in everybody's head, but everyone was pretty sure that, the new tax bill was going to take care of it. Well, now that the new tax bill has been passed, I have like 3 people where I had a meeting last week, and I have a couple meetings in the next couple weeks with the state attorneys, everyone's finally ready to act because they just now have clarity and certainty. So the exemption's been moved up. It's going to scale up based on CPI. It's permanent starting in 2026, 15 million for, 30 million for you and your spouse. Estate portability all still works, So yeah, that's how to think through that.
One
They're
thing I'm
basic Most business owners cannot benefit from the overtime deduction when paying themselves because they're not typically covered by FLSA overtime requirements. So business owners aren't eligible for overtime. Go go get a job.
um anything
That may
again
not be right, but
on
we'll do more research and get back on that.
the estate planning piece, it says reassessed gift timing. So I think that was only one thing I wanted to make sure we highlighted that now you may want to do more now. And always it's calendar year stuff. So
Yeah,
just make
folks have certainty. So ultimately, people want to now. You can go develop a plan that's not on the 11th hour you know, at the on the edge of a blade. You can just go now, develop a plan and stick to the plan, and you have now regulatory certainty about how gifts are going to be treated and about how your estate's going to be treated for a while.
So we're talking personal and kind of what it meant for your personal taxes, and now we're really going to talk more about the business side, and what that looks like from a business owner's perspective.
Yeah, awesome. So again, we start with personal and we talk about personal because for these people who own these small businesses like this, the personal and the business are almost like so intertwined that can't really separate them. But the personal provisions were a big deal in the bill because again, it was the tax cuts for middle America bill. But I mean, as you can see, most of those things phase out in 20 most of them phase out at an income limit and most of them sunset in 2028 and 2029. The big thing about the business provisions is that they're permanent. I mean, they are just like, well, we'll talk through all of them, but they did what they said they were going to do. They made the Trump's tax cuts permanent. So we'll get into it, but ultimately, like I said, like we talked about in the beginning, and like we talked about in this tweet, like the best way for me to like stair step or like progress through all of these tax changes and what matters to business owners is by just taking business owners in these like income, you know, income thresholds. And look, this is general advice. If you're growing really, really quick, or if you're going to retire in a year, this may not apply to you, but I'm just talking about in general. By the way, go look at this little S corp calculator that we have. It's kind of cool, and it starts to show you like how you might save if you're not an S corp out there today. It's worth looking at. But so ultimately, if you're this kind of small business, hey, I just went out on my own. I had a guy DM me yesterday. I just went out on my own. I've made $20,000 so far this year. What do I need to do? It's like nothing's changed because your taxes didn't matter before and they still kind of don't matter. Or like what you want to do is set up a new business bank account, or even if you don't have an LLC yet, like just go set up a separate account, a personal checking account, do something, get your business income into its own account, start moving bills over like your telephone, like your gas, like your computer, your software subscriptions, the things that you need. Shoot, even if those things cost a little bit more and you can do it, go put 10,000 bucks in the account just to seed the business, just so that you can get your business accounting started off right and everything siloed into one little world. it just makes your life so much better. You can start to go, hey, here's my income, here's my expenses, here's my cash, here's how I'm growing. Frankly, when you have excess cash and you're going to go send money home to pay your pay your rent, pay your mortgage, pay for your kids' haircuts, whatever you're going to do, like you can start to take a tax distribution right then and there. Hey, I'm going to send $10,000 home. I better go squirrel 3 of the 10 into a little checking account so that when I got to go pay taxes, I'm ready to do it and I'm not out of money. So ultimately, as you're at, 50, 100 of business profit and growing, the S corp starts to become something valuable to you. The big thing about the S corp, there's nothing magical about it, but it allows you to bifurcate owner wages from business income. So if you don't have an S corp out there and you make $100,000, you're just going to pay $15,300 of self-employment tax. If you have an S corp, you can go pay yourself a salary of 40 if that's appropriate, or a reasonable salary. I don't know if that's 20, 30, 40, 75, what it is. But then let's just say you paid yourself 40. Well, you'll pay self-employment taxes on that 40,000 of salary that you pay yourself. You'll pay the owner side and the employee side, so that would be $6,000 right there. But the other 60 will pass through, not subject to that self-employment tax, which is $9,000. So even at $100,000 of profit, the S corp can have this meaningful impact, even to small businesses. But it does create this new kind of pet that you have to, it's a new plant you got to keep watered. You got to file the franchise tax. You have another tax return. You have a set of books that you have to be mindful of, but you had to be mindful of your books anyway. I mean, there's a problem with small businesses and growing businesses, which is like they're just a liability. Like you have to do all the accounting stuff that you need to do because you're a business owner, but you just don't have the resources, and you're trying to grow your business and you're trying to do 1,000 things. So it's tough.
Yeah, we talk, I mean, I talk to people all day long who are starting new businesses and they're trying to figure out what should they do as far as when should they start an LLC? Should we what kind of LLC should they what should it all
Yep.
be? And so my advice is always to just start small. If you're still starting small, like just like Mitchell was saying, get all the expenses in one place. Just make your life easier. Your future you will thank you when you try to go in and figure out, where did you spend the money on on your Canvas subscription or your, you know,
Yeah.
whatever Zoom subscriptions. Like get all that in one place. Um,
And I mean, we're not doing the structure conversation today, but there are LLCs, and an LLC can be taxed as a partnership or a C corp or an S corp, or it can be just fully disregarded. There's LLPs, there's LTDs, there's Incs, there's a lot of business structures. Talk to a business attorney about that. I mean, really the target client we're talking to is just the small business owner who's selling some kind of like the ultimate better bookkeeping client is a technician, is somebody who has a kind of technical background, who got training, who now is going out on their own and freelancing with that training. So you go therapists,
Marketers.
high-end hairdressers,
Yeah.
doctors, lawyers, brokers, like all of these people who are like, yeah, I worked for JLL for 7 years. Now I'm out on my own and I'm making 1099 income. Somebody asked, like, do you recommend setting up the S corp already if you know the business is going to make money? Like, yeah, I mean, if you're going to make 300 grand next year and you just know that, or like, yeah, just become an LLC off the bat. We use a service called Better Legal to as our kind of like robo advisor business setup agent. I know Chad, the owner. I'm not being paid to say this. They just do a good job. It's just a simple thing. They don't try to sell you a bunch of junk you don't need. Um,
Yeah,
For
and then
banking, oh, go ahead.
no, I was just gonna say, so just from an order of operations, go get your LLC, and then with our clients, we help them with their election form to take that S election. It's a 2553, super fun. Help our clients with that. And then the other, we were talking about the hoops you gotta have to jump through. I always say that the S corp requires a PITA tax because it's pain in the ass. There's definitely more things you have to do. So the other big thing you have
Yeah,
to do is pay yourself a salary. So we work with Gusto as a paid payroll provider. The biggest thing I tell people is that all this stuff needs to be done before the end of the calendar year. So ideally, yeah, you'd go in and get your LLC, you take the S election kind of straight away. But our biggest thing is just you've got to make sure you get it done in the year that you paid yourself a salary, because that's the way you can make sure you're really being optimized. And and
yeah.
keep all this stuff in one place, and so on and so forth.
You know, in November, you're gonna get, because you're on this webinar, you'll get an invitation to the like things I wish I knew in November that I now know in February kind of webinar. But we're like, all I'm saying is you're early in the game, and but I would just go ahead and get this stuff done. I wouldn't wait till November, but and then by next February, you're totally screwed on a bunch of things. So ultimately, what does the one big beautiful bill do for real small businesses? Kind of nothing. Now we're stair stepping into the kind of 200, 100 to $300,000 range and above. The big thing the one big beautiful bill did is it made the QBI deduction permanent. They were toying around with making it 23%. They just kind of left it at 20%. They upped the phase outs a little bit. They didn't mess around with this idea of the specified service trade businesses. So businesses like so in 2017 they lowered the corporate tax rate from 35% to 21%. And so then partnership folks and S corp folks said, "Well, don't we get a tax break?" And so they said, "Yes, we'll give you this 20% deduction on your qualified business income that's out there today." And so there's a new minimum of like every small business up to that makes $1,000 gets this $400 QBI. But really, what happens is just every business that makes qualified business income gets a 20% deduction on their qualified business income. So if you are if you're any type of small business out there, you start to get this 20% deduction on, you make $100,000, you get a $20,000 deduction. Well, this is another reason for the S corp, because this deduction phases out at 197 to 272 for single people, 394 to 545 for married folks. Well, if you own a business and you and your spouse make more than $500,000, the QBI deduction starts to get crunched. You don't get the full 20%. So you have to set up the S corp, and then you have to structure a salary for yourself to be able to to be able to maximize this QBI deduction. So we do this for our clients all the time who have threshold issues. But getting back to the specified service trade business, I'm an accountant. I'm one of these legal, medical, architecture, engineering. Architecture is a tricky one because a lot of real estate businesses out there qualify for QBI. So financial investments, certain brokerage, financial brokerage, famous people, actors, entertainers, sports figures, they just phase out and they can't get QBI, even though even if they set the salary out there. So basically the QBI rules are just the same as usual, but they extended them and made them permanent. They were going to phase out at the end of this year.
Yeah, and on some of our other webinars, we've gone through like all these different topics in much more detail to talk about, what the difference is between QBI and all those different pieces. Um, In this one, we're more focused on the big beautiful bill.
Yep. Um, these are the kind of like Michael Kitces, advisor extraordinaire, drew these kind of graphs about what the deduction is and how it phases out, whether you're single or married, and this is how it works if you're uh, SSTB versus a non-SSTB. But again, the S corps are allowed to go pay anybody in the company, including the owner, a salary to optimize for QBI out there today. So yeah.
So R&D, we get a lot of conversation about this, and so wanted Mitchell to kind of go through the kind of what counts as R&D, and then what the new pieces are for the big beautiful bill.
So I wrote a long thread about R&D that someone would drop in the chat. But ultimately, R&D was had this problem of like uh, in the 1980s they released this R&D credit because they wanted people to you know research and develop technology in America. So it's a pretty broad concept, but as long as you're solving a technical issue in a novel way, you are participating in research and development. And to the extent that you're paying people in the US, you're paying contractors in the US, you're paying for direct costs like server time or supplies or chemicals, uh, and even if you're paying foreign contractors, these are R&D expenses and they are eligible for this credit. So you get this credit, it's like 8% of the expense, and you get to deduct the expense. So it's a boondoggle. Um, and so big businesses pop around that do R&D credit studies. It's worth doing if you're spending big money on these expenses. They generally take a pro rata fee. With the advent of AI and with the advent of kind of technology, these studies are getting cheaper and they're getting kind of more ubiquitous where somebody's like, yeah, upload your general ledger and answer this questionnaire and we'll do a study for you. Well, that can go well or it can go bad. But and so ultimately, like single owner business making $300,000, probably not an R&D credit business. Hey, I have a whole team of software developers and engineers in India. Yeah, yes, an R&D business. Um, if you code, you're probably eligible for R&D. The more you spend, the more you can save. The credit would be $8,000 on 100. The credit would be $80,000 on 1 million. So ultimately, the big problem was in the Tax Cuts Jobs Act. They started to do this deal where you couldn't expense the you could still get the credit, but you couldn't get the expense for the payments in year one. You were having to capitalize and then amortize them over 5 years. So actually, in year one, you would only get 1/10 of the expense. So if I'm a software company and I made $3 million and I paid $2 million in R&D expenses, I wasn't great. I made $1 million. Wonderful. Well, now I would have to pay tax as though I made there would be this add back of $1.8 million in year one. So they would say, actually, you made $2.8 million and you owe tax on that whole thing. Companies were running out of money. They were having to go raise debt to pay their taxes. They were having to go raise capital to pay their taxes. And so a lot of people smartly just were like, I'm not going to take the credit because I don't want to fall into 174 and have to add back these research and development expenses. Well, that didn't even like do what people thought it was going to do. And you know it, it, like you couldn't bypass the credit because you wanted to bypass the amortization. In theory, you were still doing it wrong, but that's what people were doing. And so, that basically in this bill, they kind of fixed all that, and they even fixed it retroactively for smaller companies. So we don't have to get that far into this. I guess we've already gotten kind of far into it. The other thing that they did around kind of like the R&D profile company is qualified small business stock, the QSBS exemption. They kind of beefed that up. So these things kind of go hand in hand. They're these C corps that go out there and spend a bunch of money and want to get all the kind of like C corp startup venture capitalist benefits out there. Those have kind of been turned back on. This is the one I'm really excited about, which is they made bonus depreciation permanent, and they made Section 179 permanent, and then they did this kind of cool write-off thing for manufacturing properties through 2030. But ultimately, G-Wagon season is back. Tax cuts, bonus depreciation has been around since 2001 after 9/11 and in the middle of the dot-com crash. They wanted to stimulate the economy. They've said, well, how about this? You can go buy a Ford F-150 and write it all off year one. And so that's effectively what bonus depreciation is. Well, then a bunch of smart people started to say, well, if I can do a Ford F-150, what about the sidewalks in my building? And what about the appliances and furniture and fixtures in my apartment complex? Yeah, here we go. Well, in 2017, it was one of the first times they were like 100% bonus and on used property. So that was this big, watershed moment for you could go buy an apartment building from the 1970s and just bonus the crap out of it. And that was getting stepped down in 22, 23, 24. It was, 80, 60. In 25 it was going to be 40%, and it was 40% for the first 19 days. Well, now it's 100%. So now you can go buy a G-Wagon, you can buy an apartment building and cost segregate it and bonus depreciate it, if you're a real estate pro, and you can go get a big write-off. Section 179 kind of never went away. The big limitation with Section 179 is you cannot create losses with Section 179, but bonus depreciation you can. So
For
that's worth thinking about.
For our clients, the biggest thing is, well, I guess there's two parts. For the car, we get should I go buy a car? I get that question once a month, once a week. I mean, all the time, because that's just like the one that everyone's interested in. And
Yep.
the answer is always, you can lease
You
a
need a
car
car?
in a sense, but do you need a car? Like, do you need the car? If the answer is yes, do you want a G-Wagon? Because you don't have to buy one just because it's available. So I know that sounds probably like common, like sure, I get it, but it's really, there's different options, and there's different ways to take advantage of this depending on how you purchase the car. So definitely always feel free to reach out. And then the other thing we get a lot of questions from folks of like, what else can I do? Should I invest in real estate? Like, what should I? And I always, like, if we have a dentist client, I'm like, hey, go buy the building that you practice, that you do your dentistry in. Like, go buy that building, or whatever. If anyone can do that, that's always a great way to create equity. You can write off a bunch of stuff. Like, there's a lot of options there.
This works better in the middle of the country than in
For
California, or I was talking to you know, shout out Mike Sylvester, Fort Wayne, Indiana, and he's like, "Yeah, every CPA in Fort Wayne owns their building. What are you talking about?" Versus you go to La Jolla, California, and not many CPAs, if they own their building, they've owned it for 40 years. You
Yeah,
know,
because the challenge is like if we get okay, should I go buy a short-term rental? Should I go buy something like that? And it's like, but do you want to be a landlord? So we will all, that's always my question back whenever we're talking through these different strategies and what is the return on hassle for these. But buying a building
yeah.
to host your own business is pretty it's going to be the lowest return on hassle when it comes to, make you unless you're a terrible tenant for yourself. But these are kind of the areas where folks could potentially go explore.
One of my favorite tweets ever. that I wrote. Sorry.
You-
I'm standing in the prospect's office as we stare out at six pristine pickup trucks. I buy one every year for the tax write-off, he says quietly. Don't even know how to stop. A man trapped by the dumbest tax strategy ever devised. And that's a true story. I like it really was in a guy's office and there were like six pickup trucks. And I was like, Let's just sell all these trucks, can we?" So there's no point in buying crap you don't need to save tax ever, you know? So yeah, what should we do next? Under 100K, get your life in order, open up a business bank account, you know, go make more money, go get your business in order. A lot of the problems that you make can either be solved at the end of the year. Some of your problems can even be solved for last year, next year. 100 to 300K, you're into S corp territory. You're setting up a salary. You're thinking about the QBI deduction. You're thinking about some of these phase outs for the senior extra deduction or some of these. You're not worried about no tax on tips, but you're thinking about, or you're not worried about no tax on overtime, but you're just kind of thinking about uh, some of those lower phase outs, but not really, frankly. 300 to 500. 300 to 500K is a big break where once you go from 24% to 32%, you're into now like I'm paying a third of my money in taxes. You you may want to stay in that 24% bracket as long as you can, and you're in the phase out for SSTBs, for QBI deductions. Like really, I just think about where are the breaks, and as I'm earning up through the breaks, where I want to be mindful. And there are certain tripwires where if you trip them, it's pretty bad, or it gets bad quick. Over $100,000, the whole thing can go away. But and then over 500K, you're starting to talk about, hey, I need to get back into PTET. Hey, I need to optimize my QBI deductions. Hey, I need to like do all the tax planning there is out there.
Yeah, and then the blanket statement is get a pro. Once you start
Yeah.
filing a corporate tax return for your business, you need someone at the helm. So
Yeah, you probably should not be like turbo-taxing S corp or a partnership return. Like, my hope is that pro could save you as much money as they cost you, and the job to be done. Like, just get it done. You know.
yeah, yeah, no. And I mean, it's amazing how many people I talk to who aren't optimized for QBI, have S corps, but aren't making these their CPAs haven't been giving this advice to them. And so because like we keep talking about some of these S corp things that have to happen there are some more triggers and more things you have to do. I mean, and the minute you own your own business, you do have to pay quarterly taxes, but how do you know what that is? And making sure you're on top of all those different things, on top of all of your expenses and your payments, and just a lot of pieces to mention and to think through. But optimizing your tax savings is a place that really you can save a lot of money. So try to find somebody. Better Bookkeeping here to help, but in any case, find someone who can help you.
Yeah, we haven't done a ton of case studies here or anything, but even just that case study off the top of my head of just what if you make $100,000, what an S corp with a salary could save you. It could go save you $9,000. And of course you have to go then pay for the S corp and pay for paying yourself a salary, but it starts to scale from there. And QBI optimization is just a big deal. Like we um we save client, like aggregating your QBI right, paying yourself a salary right. It can be $30,000 for big earners. Or the PTET's another huge one. The pass-through entity tax that can save people 20, $30,000. It's a hassle, but that's why we do it. So yeah. So we talked a little bit about this, and we appreciate y'all's time. If you have more questions, hit it in the Q&A. We have a little bit of time left. We'll answer some questions, but you know if you're done with DIY, if you didn't go into business to do your own books, you didn't go into business to do tax planning and tax returns. Again, we talk about the better bookkeeping client being this technician who is a technical expert at their craft, has taken it out and gone on their own and started to freelance and started to build their own business. But we don't have many tax accountants as our clients. They're mostly lawyers and
We
real
work with
estate
financial
brokers.
planners. We also work with a lot of people who are creators, who are marketers, who work for
Yep,
themselves. We've got uh,
agencies.
all sorts of,
Yeah.
I mean, I love the variety of the clients that we work with, but there is a key to everyone, which is, in our client base, 90% of them have an S corp in their world because it's one of the best options for, and that's what we specialize in, is making sure that everyone's taking advantage of the things. Yes, there's work that has to happen to have an S corp, but we try to make that as easy as possible.
And so, the promotion we're offering today is we'll catch you up for the whole year for free still. We're not going to do this like Labor Day is my cutoff. I'm done. If you come in after Labor Day, you got to pay us to catch you up. But we're excited to build this business. We're excited to grow our customer base, and the investment we're making into our clients is catching them up from the beginning of the year. Shoot, if you still have to file 2024, we can probably get it done for you. I don't think we're doing that for free, but we'll charge you a nominal amount to get you started, get you on the platform, and get you going. And then we'll go make September payments and go make January payments and get you right on track.